Okay, welcome and thank you everybody for joining us for another session of our CFA Society Ottawa webinar series. We were calling this the summer webinar series, but as most of you have seen, the leaves are starting to turn. We had some frost in the region last night, so good news on that front that we're not going to be confined by the seasons. We'll continue to extend this series into the fall and beyond. I think we've certainly stumbled upon something that's going to have some lasting power even once things return to normal. My name is Ian Taylor. I'm the Vice President of the CFA Society Ottawa this year. I just want to remind you that the previous sessions that we've held, they continue to be available on YouTube and are linked from our website. So if you happen to miss those, or today, if you happen to fall off, halfway through the presentation, you can always go back and see that great content online, if that happens to be the case. Before starting and getting into today's presentation, I just wanted to say a quick thank you to Wesley Blight, our past president, for arranging the annual golf tournament last week. And also a thank you to those who attended. We're really looking for opportunities in this environment to socialize and network in a safe way. Greyhawk Golf Club once again provided a really good venue for that, and I know everybody who was there had a great time getting out. Certainly something I was looking forward to, so really happy that we're able to host that again this year, and we're going to continue to look for different ways to interact, and maybe not the same way we have in the past, but do it in a safe manner going forward. And we certainly look for your input on that, over the coming weeks and months as things evolve. And all of that is really a reflection of, the environment we're in today. And I think, that's a great sort of segue into today's topic. So this year, it'd be an understatement to say that it's been a wild ride for all areas of the capital markets due to the outbreak of the COVID-19 virus. Again, here we find ourselves in an environment of historically low interest rates. Yields are low across the curve from a treasury perspective. We've seen credit markets actually snap back quite quickly. So, corporate bonds are even trading at historically low levels of yields. And we know, different areas of the stock market are now trading at or near record highs. And that's probably got a lot of investors wondering, once again, what's the outlook in particular for a traditional investment strategy? What's the return prospects there and from that perspective? And I think that's where today's topic is going to lend some perspective. So when I hear the term absolute return strategies, which is the topic today, I get a similar feeling to when I hear the term hedge funds. It's just one big broad category, big bucket of different investment strategies. And we know, there's different levels of transparency, liquidity, leverage, cost, diversification. There's a whole number of different considerations that go into that. So I'm looking forward to today's speaker to provide insight into the landscape for absolute return strategies, but perhaps more importantly, how these strategies can help contribute to a successful investment strategy going forward, recognizing the current environment that we're in. So with that, I'm going to introduce our speaker today. We have Michael Sager. He's a member of the CIBC Client Portfolio Management team, responsible for working both internally and externally with partners to develop effective investment solutions for prospects and consultants. Prior to joining CIBC Asset Management in 2018, Dr. Sager was an asset allocation consultant at Alignvest Investment Management. Previously, he was a senior portfolio manager at the CPPIB. He also has portfolio management and research experience from Wellington Management, JP Morgan Asset Management, European Central Bank, and the Bank of England. Dr. Sager earned his PhD in economics from the University of Warwick, and he has a Master's of Science degree in economics from the University of London. So with that, I'll turn over the virtual floor to you, Michael, to speak about absolute return strategies.
Great, thank you very much, Ian. Thank you very much, everybody, for attending today, for tuning in. As you said, Ian, at the start there in that introduction, absolute return strategies, the phrase absolute return strategies does encompass a myriad of possibilities and different constructs. So we'll talk a little bit about that today. But we'll also, as you suggest, position absolute return strategies broadly within a portfolio. What are they? What challenges do they potentially help solve for? And what does that solution look like? So those are some of the objectives. Happy to take questions. I'll leave plenty of time at the end. And if there are some that we can address as we go through, I'll also do that. So please feel free to question, comment, feedback. All is appreciated and welcome. So with that, let's begin to think about the role and relevance of absolute return strategies in the investment world that we find ourselves today. Absolute return strategies, to our mind at CIBC, are part of the alternatives bucket. And just as absolute return strategies encompasses a myriad of different opportunities and solutions, so does the term alternatives. And for the first couple of slides, let's just define some of the landscape of that term alternatives. So as you can see on the slide on the screen, alternatives encompasses both asset classes, but also strategies. By asset classes, I'm thinking about, you can see in that bottom left light blue bucket, currencies and commodities in terms of liquid asset classes. And then from an illiquid perspective, real estate, infrastructure, for example. So that's alternative assets. On the strategy side, you can see listed there at the top of that bottom right bucket, absolute return strategies. And absolute return strategies, as we've already talked about, encompass a number of sub-components. So they include the asset classes, or at least some of them that I've already mentioned, currencies and commodities, as well as equities and bonds. They include idiosyncratic strategies like we've listed there, third down, event-driven. But they also include things that are closer to our expertise at CIBC, for example, global macro, top-down investing. So a really broad array. And again, within alternative strategies, a mix of liquid and illiquid. All have their place in a portfolio, we think. All contribute something different. The key is to understand what they contribute relative to what you already own. What risks are already in the portfolio, and how can we diversify those risks or augment the expected outcome to your portfolio by adding in absolute return strategies or other alternatives. So that's the challenge. And we'll talk about a few ways that investors who have embraced both absolute return but also alternatives more broadly have thought about those challenges. So when we think a little bit more about illiquid and assets and strategies, and then particularly for our discussion today in the bottom right there of this slide, liquid strategies, what can we achieve by allocating to liquid strategies, including absolute return, multi-asset? It's a number of things, and we've listed some of them there. Enhancing expected return, improving the liquidity profile of the portfolio, which I'll talk about in a moment, has come front and center for a number of investors since March. An ability to endogenously tilt between the core components of a portfolio without having to add additional tactical managers to the suite of managers already investing on one's behalf. It can be an equity substitute, a fixed income substitute, and also a complement to illiquid alternatives. So liquid strategies, including absolute returns, have a an array of opportunities, an array of uses that can be applied to all manner of portfolios. And we're going to talk about some of those in the next 25, 30 minutes, something like that. Okay, so that's a little bit of an introduction on the broad landscape. Let's talk about now for a couple of slides how different asset or investor groups have embraced alternatives, including absolute return strategies. And we've given a few examples here that range from the Canadian mega plans like My Old Shop at CPP, or Ontario Teachers on the right there, OMAs, to US endowment funds, ultra high net worth, through to more regular retail investors. So you can see that this chart shows the average allocation within those broad buckets, and also the specific allocation for the likes of the Canadian mega plans, allocations to alternatives, including absolute return. So you can see at one extreme, Ontario Teachers up at around 65, 70% of the portfolio in a mix of liquid and illiquid strategies and assets. At the other extreme, retail investors have really not got going yet, broadly speaking, in terms of allocating to this bucket of risk, this opportunity. I think the trend has begun and is likely to continue, so that retail trends up somewhere around between high net worth and ultra high net worth on this chart. So there's a big opportunity, and for average institutional, there's already been a big allocation. So that's the background. What are the trends, just to carry on my last point? The slide on the screen now shows you data from a recent institutional survey from BlackRock for each of the different asset classes shown on the chart. Are investors broadly looking to increase, decrease, or keep their current allocation the same? So you can see, I think, broadly speaking, for equities and fixed income, particularly equities, it seems that we've not quite reached steady state yet, particularly for domestic equity allocations, and that is still going down. Whereas if you move into the middle of the curve, the middle of the chart, for a lot of the illiquid strategies, private equity, real estate, real assets, we're still shifting towards allocating more of portfolios to that opportunity. Hedge funds, which Ian, I think, quite correctly conflated with absolute return strategies to some extent. You can see hedge funds there, probably at a status quo when this survey was taken, although survey data over the last several months post the most intense part of COVID suggests now that allocations and interest in allocating to hedge funds and absolute return strategies is now increasing quite aggressively. So that's the lay of the land and how it's changing. One point that I would raise at this point in the presentation is to think about illiquidity within portfolios. So I mentioned that a lot of institutional investors have embraced alternatives, and that embrace has focused particularly on illiquids, which sounded like a great idea in the period 2009 to 2019, where the search for a return enhancement was particularly front and center. Of course, what COVID taught us again, particularly in March, is that switching one concentrated risk for example, equity exposure. For another, too much illiquidity is probably not a good idea, and hence the renewed interest in more liquid absolute return strategies to balance out the liquidity versus illiquidity profile of portfolios. So I think that's an important thing to bear in mind, that too much of a good thing is always bad, and that includes illiquidity. So let's focus on the challenges that, and I'm just looking down, making sure I'm good for time, by the way, which I am so far. Let's just focus on what are the challenges that investors in alternatives, including absolute return strategies, are trying to solve for. We have some good data on this. Preqin, which is, as many of you I'm sure know, a provider of insight and intelligence and data on alternatives, a US provider, does a regular institutional survey. And so they asked, what are the key challenges, the key needs that you're looking to alternatives to solve? And you can see the answer on slide 7 here. About 75% of respondents, regardless of whether it was an illiquid strategy or asset or a liquid alternative, 75% of respondents said we need more diversification in portfolios. A similarly high number, something like 50% of respondents in the bottom right of the web chart on the screen said we need more return. So those were two of the key criteria. I would add that the third one we're increasingly hearing about is the one I just mentioned, liquidity. So let's address, over the minutes that remain in the presentation, how absolute return strategies can help with diversification and absolute return enhancement, and why those are important challenges. So let's address the why. Why are they important challenges? Why consider alternatives, including absolute return strategies? That's a fairly easy question to answer. If you look at the screen, the slide on the screen right now, what we've done here is draw out an illustrative traditional portfolio, a global balanced portfolio. On the left-hand side, the pie shows typical capital allocation to a balanced portfolio. It's a 60-40 in this case, so 60 cents on the dollar goes into equities, whether it's a mix of domestic and global. 40 cents in the dollar goes into a mix of fixed income, including sovereign, municipal, corporate, high yield, emerging market. So it sounds balanced by name. But if you look at the right-hand pie, of course, I think most of us are aware that a balanced portfolio is not balanced at all, particularly thinking about it from a risk perspective. And here in our illustrative example, based on volatilities and correlations, over 90% of risk in a balanced portfolio comes from equities. It's very concentrated. Now, that's not a problem when we're in a good market environment and in turn in a good macro environment. Equities are the cornerstone of portfolios. They have been for the past 100 years or so. We think they will be as far as the eye can see going forward. And you can see from the screen on the slide on the screen right now, each of the bars shows the performance of our balanced portfolio in a different macroeconomic environment. The first one, the tallest bar on the left there, growth rising and inflation gently declining. and so on and so forth. You can see the other three described on the bottom. And then we're showing on the vertical axis the performance of the balanced portfolio in that market, that macro environment. Performance is defined as a Sharpe ratio, return per unit of risk. And you can see in that first environment, that pretty benign economic environment, balanced portfolio does very well. This is historical data over the last 15 years or so. But as you move over to the right-hand side of the chart, having a concentrated equity exposure is punitive in periods where growth is falling and either inflation is falling or inflation is rising. So concentrated exposures in a portfolio are only good in certain periods of the world. Other times it pays to be diversified. So that's one of the reasons I think that investors are looking to absolute return strategies and alternatives broadly to solve this concentration of risk that they have in traditional portfolios. You know, if we think about the other part of balanced portfolios, fixed income, here we have a couple of challenges going forward, particularly in the traditional core part of the portfolio, sovereign bond exposure of the portfolio. You know, on the left-hand chart here on slide 10, we're correlating current yields with annualized average expected return over the next 10 years. And you can see, and I'm sure most of you are aware, there's a pretty tight fit. Whatever the current yield is, that's your best projection for the average annual return to that fixed income instrument over the next 10 years. So Canadian yields on 10-year sovereign at about 55 basis points currently, that's your expected return. It's less than the average return to cash that we expect to see over the next 10 years. So you're paying relative to cash to have that exposure, which is fine because fixed income also performs a number of key functions within portfolios. One of those functions that I'm going to focus on, as well as return, is diversification, given that that's the challenge investors are trying to solve for with absolute return strategies. You can see on the right-hand side of this slide the correlation that most of us have lived with in our careers between equities and bonds, you know, beginning in the year 2000 or so, has been negative. So you've had a very nice hedge benefit from being exposed to sovereign bonds. But let's have a bit more of a long-term focus when we're doing our analysis. And so the chart on the right, as you'll see, actually takes data back about 260 years to 1763. And you can see now that in that context, a negative correlation is very much an anomaly rather than the norm. So I think that we should be prepared that a normal correlation is 0 to positive going forward, so that hedge benefit of core fixed income is undermined from two perspectives. You know, first of all, because of the low yield, and second, because of a less supportive correlation structure going forward. So you can see the point about the yield on slide 11 here. What we've shown you is since 1990 on the left-hand chart, the median drawdown to the S&P 500. In periods when the S&P falls, what's the median decline? And you can see by that dark bar on the left-hand side, it's 15%. what's the median increase or median return to sovereign bonds in the US and Canada during those periods? It's around about 5%. So it's a partial hedge, a partial offset, which is good to have. And we've shown the behavior of gold and the yen, similar behavior. So the question then on the right-hand side, let's just have a thought exercise. If we wanted sovereign bonds to completely offset that median S&P drawdown going forward, where would yields have to go to from their current 55 basis points or so? And the answer you can see on the right-hand side is an implausible negative 1.5%. So it's not going to happen. What that means is we need to find other sources of diversification. So just as we're trying to diversify from the macro risk inherent in equity concentrations, we also need to find ways to diversify fixed income, at least core fixed income, given the low level of yields particularly. The other reason we need some more diversification in portfolios is looking at the broad correlation structure across assets that typically are represented in a balanced portfolio. So here we've shown the average pairwise correlation between a range of equity markets, bond markets, commodity markets, and currencies. You can see them all listed in the footnote, at least the futures code from Bloomberg. The key takeaway is that this is a 3-year rolling correlation. So since the advent of the euro, pairwise correlations across equities, bonds, commodities, and currencies have increased quite significantly. And they've stayed at relatively high levels. It's another challenge to find diversification within a balanced portfolio, within traditional asset classes and traditional strategies. So if we can add some enhancing absolute return strategies, we can find ways to diversify the portfolio. So these are all the aspects of that first challenge that investors are trying to solve by turning to absolute return strategies and alternatives more broadly. So let's have a think about the behavior of asset classes again. Let's go back to that world when the S&P is my proxy for equities, when the S&P is either declining or increasing. What does asset return performance look like? So what I've done here on this slide, both charts have the same assets and the same rank ordering of assets. The left-hand chart shows you the performance of all of those equity, bond, currency, and alternative asset classes and strategies when the S&P loses more than one standard deviation in a month. The right-hand chart shows you the performance of those same asset classes and strategies when S&P monthly returns are positive. Of course, in the perfect world, what you want is a healthy exposure to the asset classes that we've highlighted, the likes of real assets, high yield, emerging market bonds, global bonds, but also private debt. And of course, the last one listed there, absolute return strategies. They are negatively correlated when the S&P is significantly down, but they are positively correlated to equities when the S&P outperforms. So it is possible to have that really great correlation structure using a broad set of traditional and alternative strategies. saw the question on the outlook for the next 5 years. I'll address that in a few moments. So just let's hold that thought and I'll come to that. So we've talked about the first of the two challenges, the need for more diversification, whether it's because of risk concentrations or whether it's because some of the challenges that core fixed income's facing now. The second challenge, the second criterion that investors in absolute return and alternatives are seeking to solve is trying to enhance expected returns. So you can see on this slide here on the screen, these are our annual average expected returns over the next 10 years for a variety of predominantly traditional asset classes. You can see on the left there my point about let's focus on the dark bars because that's the post-COVID update to our return expectation. You can see my point about global bonds and US government bonds likely to underperform cash on average over the next 10 years. If you move over towards the right-hand side, you can see Canadian equities. In April, we expected around about, close to 7% return plus cash. Of course, that's come down in the last 3 or 4 months. We're closer to 6%, around about average. On the right-hand side, though, look at emerging bonds, for example, emerging equities. Emerging bonds, recall from the last slide, had that really great correlation attributes to core equities. It also has a relatively attractive return outlook. Why is that important? Well, here we're showing you the performance of a traditional balanced portfolio. Each of the grey lines shows you the cumulative 10-year performance to a balanced portfolio. We've defined it in the footnote. 10-year cumulative return. Each one of the lines starts at a different year. So one of the grey lines starts in 1988. Another one starts in 89, 90, 91, 92, and so on and so forth, and then accumulates the subsequent 10-year performance to that balanced portfolio in excess of cash. The blue line shows you the 10 years ending in December last year. So the last 10 years was the best 10 years for a balanced portfolio since 1988. The black line shows you the average outcome to the balanced portfolio over that period. And the red line is our 10-year forward-looking outcome to that balanced portfolio. It looks, average. I wouldn't split hairs and say it's particularly different from average. It looks average, not spectacular, but also not nothing like the grey at the bottom that straddled 2000, 2001, for example. So it's an average outcome. Can we improve that outcome by allocating to alternatives, including absolute return strategies? We think we can. We're not trying to suggest that we have a magic wand and it's easy to get back to the blue line. Absolutely not. But can we just improve a little bit relative to the red and black line over the next 10 years by allocating to more alternatives, including absolute return, improving diversification, enhancing expected return? We think we can. And here we're showing once again our long-term expected returns, this time in risk-adjusted terms. So again, the vertical axis is the Sharpe ratio of all of the strategies we're showing. The dark bars are traditional asset classes and strategies. The beige lighter bars are alternatives. And as you can see, the further you move towards the right of the screen, the more it becomes populated by alternatives, including on the far right, liquid alternatives, multi-asset absolute return strategy, that's pulling on a lot of the underlying strategies and giving a lot of diversification and therefore potentially a lot of expected return enhancement. So solving for that second challenge, how to improve expected returns. So the question is, how are absolute return strategies doing that? How do they propose to do that going forward? And it really is an emphasis on diversification. Diversification on the top left pie by incorporating a variety of asset classes, but also a variety of geographies, diminishing home bias in particular. Diversification by sources of return. On the top right, whether it's a mix of beta, but also alpha and different alphas. Bottom right, different ways of putting a portfolio together. It's great, and I'll talk about what drives, John, in a moment, what drives the Sharpe ratio for liquid alternatives. Putting the portfolios together in using quantitative strategies, but also qualitative judgment, and then different investment horizons. So we have a question that I am going to address now from John. What drives the Sharpe ratio to liquid alternatives? Why is it relatively attractive? And I think it's this slide explains that. The broader your opportunity set, the broader the investment opportunity, the more diversified the inputs, the more chance you have of adding value from a strategy or an asset class. Multi-asset absolute return strategies tend to be very broad in their opportunity set. And I think this slide, whether it's asset class, geography, the mix of beta and alphas, the mix of investment horizons, really sums up and explains why an absolute return strategy can be more additive than a single asset class or a single strategy that has a much more narrow investment opportunity. So John, it's really the breadth of opportunity across all of these dimensions. So let's think about just a couple of finishing points. So we've talked about the challenges, diversification and return enhancement. We've talked about one of the ways to solve for those by getting breadth of opportunity and true diversification in the portfolio. Let's look at what this looks like. Now I've used, I'm not, this is not a product pitch, so I'm not going to go into details about the strategy. I used the highlight. But here I'm showing you the pairwise correlations of one liquid alternative absolute return strategy with a mix of real assets, illiquid alternatives, so that encompasses on the left-hand side their infrastructure and real assets, a mix of equities, and a mix of fixed income. And you can see that those average pairwise correlations are really attractive. Now, I'd caution that the investment horizon, the historical period over which these are calculated, is only approximately 2 years, so a little bit of a grain of salt. But importantly, this is what we should see in terms of diversification for an absolute return strategy. Very attractive. Whereas if you look at the deep red, the correlation between illiquid alternatives and equities, for example, is typically very high and often close to 1. So no diversification from illiquid alternatives. They're offering you perhaps return enhancement and income enhancement, but absolute return strategies tend to provide diversification. And that provides you with the opportunity on this slide, keeping with that same absolute return strategy. If you can get that sort of diversification with strategies that also are adding return by themselves, then you tend to get this northwest shift in equity or balanced investor portfolio profile. So you can see on the left-hand chart, for example, allocating progressively more to the absolute return liquid alternative strategy from a starting point of a 60-40 portfolio and allocating out of equities improves both the expected return, but it also reduces the risk of the portfolio. And the same outcome for a 40-60 equity bond starting point portfolio as well, for example, on the balance side. So diversification and return enhancement because of the breadth of the opportunity. But of course, just to finish up on the final 2 slides, average diversification, average performance is great. But let's go back to one of those earlier slides that I showed. What you really need is an ability from your portfolio to outperform when equities are struggling, when equities are under stress, whether it's this month in September 2020 or it's 2020 Q1 or 2018 Q4. Can you uncover absolute return strategies that generate positive performance in those periods when you really need it? That's the key challenge, and we're giving an example of one that has done that. It's not the only one, but this, as well as average performance, it's important also to think about performance when you really need it. And then finally, just to come back to John's question about why would a liquid alternative absolute return offer you enhanced expected returns and diversifying expected returns. It goes back to the point I made earlier, the breadth of the opportunity set. For a number of single strategy alternatives, it's a very narrow opportunity set. For a multi-asset strategy, the light blue line on this chart, the strategy encompasses a very broad asset set, a very broad mix of strategies, lots of geographic diversification, and it's that mix, that broad opportunity set, that really allows you to enhance returns in a very diversifying way. So there was another question before I hand it back to Ian, just to finish up with my comments, which I hope people have found useful. Which absolute return strategy are you most bullish on for the next 5 years, and why? I think, again, I'm not somebody who would like to bet one horse or another, or one narrow strategy or another. I think the more flexibility that you can incorporate into your absolute return strategies, the better. And that the flexibility and the breadth allows you to tilt between styles or between asset classes as the expected return to those styles or asset classes becomes more attractive. So rather than, for example, going all in and putting all your eggs on growth or value, better to reserve the flexibility to tilt between those styles, for example. The other thing I would emphasize, of course, is that in the absolute returns space, there's been a plethora of strategies that have been brought to market over the last 2 years in Canada. I think the key thing is experience. A number of those managers are new to the space. They're learning as they go. They were perhaps previously long-only equity or fixed income managers. Experience is always good. So if you can find an experienced manager who's managed to perform over the long term with a breadth of investment opportunity, then that's where personally I focus. We've got another question from Sean. What should expected returns be going forward? Well, you know, just to go back to that slide I showed previously, I think expected returns are a little bit more, I'm just checking the time, I don't want to overstay my welcome. Expected returns are certainly less attractive than they were a few years ago, but we should be a little bit careful with sort of broad brush statements. You know, if you think about equities, normally people say equities are overvalued, but it's not true. Some equities are overvalued, some markets are overvalued. US large cap looks overvalued, US small cap doesn't. Emerging market equities don't. But again, broad brush statements about emerging markets are dangerous. So equity markets in emerging markets, where those markets have strong fundamentals, look relatively cheap. So I think we have to be careful about broad brush statements. Return expectations in the developed markets in equities and bonds, I think, are less attractive than they were 2 or 3 years ago. I think that's a clear thing we can agree on. A US large cap is probably the least attractive, and sovereign core bonds look fundamentally unattractive, but of course do provide other services to a portfolio. So I think it still pays to pick and choose and to do the fundamental analysis to understand which regions are fundamentally attractive, and within those regions, which assets and markets are attractive. But as a broader statement, fundamentally attractive EM markets, I think we can find some both equity, bond, and currency value in all of those markets relative to particularly the developed markets right now. So with that, I'll hand back to you, Ian.
Hey, thank you, Michael. Lots of great content there. Thank you for sharing the perspective, and we are starting to see some questions. So there's multiple ways you can answer ask questions in the Q&A, as Sean has here. If you'd like to, also in the chat, we'll pick it up wherever it is. And Michael did a good job of answering a few of those questions. I must say, I definitely liked slide 10, where you had I think it was over 200 years worth of correlation data between stocks and bonds back to 1763. I think that kind of that kind of information is something that I think it's all worth reflecting on. But as we look at the liquid alts, I guess a question around, and you were touching on it right at the end there. Is it a matter of, and let's say I'm a retail investor or even a high net worth, but maybe I don't have the resources to assess managers and all the different strategies that are available. Is it still a benefit to me to allocate to these types of strategies, maybe without you know, a full perspective of what's available to me, or how important is manager skill? And we've certainly seen, like you mentioned, the launch of a lot of different strategies. You know, is it possible to commoditize this, or is skill of most importance before you you know, go out and allocate to this asset or asset class?
Yeah, I think that there's a couple of points there. It's definitely possible to commoditize. I think a lot of a number of the managers who are now offering liquid alternatives in the retail space have been offering the same strategies to institutional investors for a long time. So the teams, the strategies are tried and tested for some of the biggest institutional investors in this space. You know, I think manager due diligence is important, and that includes in liquid alternatives, because as I mentioned, a lot of the strategies that have now come to Canada in this space have no history in the institutional world, no history in the retail world, and it's really investors who, as I said, have previous experience in long only investing in equities or bonds, or equities and bonds, but are now going into long short investing. Maybe they're using derivative fulfillment for the first time. Maybe they're in currencies and commodities for the first time. So I think it is important to identify managers who have got a track record of investing, because it's a very different opportunity set from long only. You know, being able to express your insight on the short side as well as the long side in new asset classes is very important. I think the other aspect, and you touched on it at the start, Ian, is, you know, when you conflated hedge funds and liquid alternative absolute return strategies, I think there are definitely a number of similarities. Some of the investment strategies that the two use are very similar, and for good reasons, because again, they're tried and trusted. They exploit market anomalies or risk anomalies in the market that have been persistent for decades. But there's also really big differences that people should be aware of. You know, the liquidity is not there for hedge fund investing. You typically have artificial lockups and gates, whereas for liquid alternatives, they are offered as mutual funds. So they offer T+2 liquidity. They offer mutual fund regulation. They offer much more transparency. And the other big deal relative to a hedge fund is the fee structure. You know, it's not 2 and 20, it's much, much lower. So I think, you know, there are important overlaps with hedge funds, but there are also important differences. So understanding the managers who have got experience, understanding what you're buying is always important. And I think that's no different in liquid alternative absolute return.
Thank you. And then maybe this will tie into some of the questions John's asked, but benchmarking. So when we're talking about these types of strategies, you know, it's fairly easy to benchmark a U.S. large cap strategy. When we go into this environment, you've talked about diversification, the breadth that's there. You know, how do I assess, you know, what value is being provided over and above some other naive strategy with respect to this? And in particular, like, you know, how do you benchmark this type of strategy?
Yeah, I think that's a important thing, and oftentimes people think about the benchmark as just cash. So sometimes some of these liquid alternative strategies will say, well, our objective is to be, you know, to positive returns in excess of cash. You know, it's a bit of an unambitious objective at 25 basis points for 3-month cash. So the way we think about it at CIBC, at least, is to say our basic benchmark is cash. But the important thing about absolute return strategies is that they're not like benchmark relative. You know, if you're an equity investor and you invest versus the S&P, you have that happy experience on every December the 31st when your benchmark resets. Did I beat the benchmark this year or not? Absolute return, the benchmark, if you think about it as cumulative performance, keeps going. So in the CIBC Mars fund, for example, our benchmark is cash plus 5%. Every day we're against that bogey. So, you know, 5% compounds up very aggressively, and you need to keep ahead of that. So that's what we're trying to keep up with, 5% plus cash. If you fall behind that, it's very difficult after a while to catch back up. So I think that's a meaningful benchmark. But if you add in also, you know, you think about those correlation data I showed, if you can do that 5% plus cash, you're going to generate an average return very similar to annual average expected return to Canadian equities. But you're going to do it with a beta to equities of 0.2 or less, which is very accretive to a core portfolio. So if you can achieve all of those, then I think the add to the core portfolio will be very attractive.
So I think that starts to move into, I mean, if you've seen Sean's question there, you know, he's asking around, you know, what's the nominal return or return expectation relative to the S&P 500? So given, you know, these strategies aren't intended to have a high beta, certainly the low correlation you've talked to stock markets, but also bond markets. You mentioned that, you know, okay, you want these to perform well in a drawdown environment, and Sean mentions here, is this like a fixed income investment? But certainly if you're targeting, you know, 5% over cash, even though cash is basically nothing at this point in time. But if you're targeting a 5% return, you're certainly not in fixed income at this point in time. So maybe just play off those two things, you know, beta versus maintaining a low correlation, still able to achieve, you know, a really positive, I guess, nominal return from that perspective.
Yeah. You can, you know, we focus so far on sovereign 10-year or sovereign core fixed income. And talked about the low return expectation. There are more return opportunities still available. You know, if you move out into more eclectic fixed income, so if you go out into, you know, Canadian corporate, you pick up some expected return. You go into US high yield, you go into emerging market bonds. So fixed income does have, as well as all of the other, you know, the liability matching, partial hedge attributes, there are opportunities to pick up return. But as you move into those more eclectic sleeves, you compromise on liquidity and you compromise on portfolio risk. So you add more risk and you take away liquidity. Whereas a liquid alternative absolute return strategy will have an attractive return relative to most of those fixed income sleeves, but it will do it with the risk of, you know, a corporate bond, something like a corporate bond, and it will do it with the liquidity of a sovereign bond. So it's very attractive. Then you think about, you know, from the perspective of equities, a liquid alternative is not going to keep up with equities in 2019 Q4 when equities went up 20%. It's not going to keep up with the NASDAQ this year, for example, notwithstanding the last 2 or 3 weeks. You know, the NASDAQ had gone up 27% or something just prior to that. It's not keeping up with it because it's taking bond-like risk. You shouldn't expect it to. But if we look at it from a long-term investor's perspective, and we tend to think about the next 10 years as being consistent with that perspective, you know, our view on Canadian equity expected return is again, probably today a little bit shy of 6% annual net of cash, whereas the liquid alternative is 5% net of cash. It's a very similar return. but with half of the volatility of equities and a low beta. So it's going to be accretive. I saw a question there. Another question was talking about downside capture, upside capture. You know, I don't have a broad number, but I can certainly point to some of our experience that, you know, in 2018 Q4, a positive outcome for a liquid alternative versus a negative for equities or balance. 2020 Q1 was the same experience. So the capture characteristics of a liquid alternative relative to core equities has been very powerful. Now, will that always turn out? No, of course not. Do liquid alternatives have drawdowns? Of course they do. But the challenge for the asset class is to minimize the size of those drawdowns, minimize the length of those drawdowns, and try and make sure that they don't occur at the same time as the core portfolio. You know, that's all a tall list, but it's feasible potentially given that breadth of opportunity set. So that's the way I would think about the synergies between fixed income and liquid alternative absolute return, and equities and liquid alternative absolute return.
Okay, so just a quick check here. It doesn't seem like we have any other further questions in the Q&A, and we are getting closer to time. So I just want to take this opportunity to thank you, Michael Seeger from CIBC Asset Management, for the presentation today. I think lots of great takeaways that we can get from the absolute return strategies. Again, those of you who maybe joined late or want to watch it again, we will have this posted as we do the other sessions that have happened for the CFA Society Ottawa webinar series on YouTube. So that link will be available. And yeah, look forward to further programming. I know we have another event coming up on September 29th. But again, thank you, Michael. I appreciate the insight, and thank you very much.
Thanks, Ian, and everybody at CFA for facilitating, and thank you all for participating. Have a good day.